All right, guys. So I know that obviously my bias for the market is long, as it should be, and definitely in the long term it is long. And I foresee a lot more gains to this bull market. But I'm going to play the advocate for the opposite side of my opinion, just to humor it, and talk about what is the worst case scenario for someone who's bullish on this market. Well, in my opinion, the worst case scenario is this this low right here. So that's about 5,000 points back down. Obviously, just like what I'm saying is the worst case scenario would be like somewhere below this low. The reason being that there is a small imbalance in the market, kind of, sort of, right here that I see between this major low and this high. Obviously, there's another high, and I think it's already been balanced out. But like, let's just say, I don't know, somehow it goes back down to like the COVID high, which it didn't quite hit yet, right? I probably, even if it was worst case, it probably wouldn't go down this far. So what I'm saying is, based on my investing strategy, that targeting this low would be good. So very worst case scenario, if you really want to protect your account from any real form of risk, this should your buying plan should allow for this to happen. So don't fully leverage. Don't do what I was doing, where I was fully leveraging into positions on the way up at lows. You would leverage, like, let's just say 5% here, 5% here, 5% here, 5% here. So that's 20% so far. 5% here, 25, 5% here, 5% here, 5% here. I already lost track. 5% here, 5% here, 5% here, 5% here. Something like that, right? Or maybe it's like 6%, whatever you want to do. But worst case scenario, it goes below this low. I'm not trying to say this to save myself from my claims before. I really don't believe this will happen. But if you really, really want to be a safe investor, that's the way that I would leverage my account. Okay, so I would say, like, each swing low that it's made through this bull market so far this year, I would enter like 5% of my account. Okay, my account's not big enough for me to really realistically do that because I'm trading options. I mean, I guess I kind of could in a way, but it would be very complicated with options. But if I was trading shares, stuff like that, that's how I would do it. I would just enter 5% of my account each time price goes below a swing low from this bull market, all the way back towards this final low. Because really the worst case scenario is that they take out this swing low right here, and then from there the market would rip up again, make new highs, continue higher, end up doubling within the next 10 years, stuff like that. So that's really my worst case scenario that I'm just preparing you guys for, is if you really don't trust the bull market, that's probably the smartest bet to do that will still be lucrative for you in the long run, right? And I wouldn't be shorting on the way down to there. I mean, you could try that, but I'm not going to do that. You could maybe hedge and buy like some cheap puts just to hedge for your like your long positions. Buy a few puts that are cheap right now, and in the odd event that your long positions go into some big drawdown, at least your puts would hedge for you against that, right? And if the puts end up being wrong, well, your long positions will still pay out, and you'll just lose a little bit of the gains to the puts that were cheap, right? Which, honestly, I might do that. I'm not going to buy like a bunch of puts, but I might buy like a couple of puts for QQQ or something. Just like two cheap puts that are like, I don't know, like $45 a contract or something. Like, just put $90 in like a one-off chance that it goes back down to there. In which case, those puts would pay out pretty massively and protect my long positions, so that it would at least kind of keep me at a break even state if the market does tank, right? And if the market keeps going, the worst is that I lose $90 of my entire portfolio, while the rest of it gains way more than $90, right? So that's kind of what I would do, right? It's pretty safe, but I'm not saying you need to do that. This is just worst case scenario. Absolute worst case scenario I could ever see for this market is this low being taken out, and then it reverses and goes back higher. Okay, so I just wanted to say that for you guys so that it's out there. I've said it is, and maybe it wouldn't even be this low, but this low right here. But you see what I'm saying? Like this area right here is the worst case scenario that this market will ever see again, ever. So I'm giving you right here where your max risk should be. Like at this point, whatever is left of your portfolio, you should just buy. You should just fully leverage in whatever's left of your liquid cash, whatever's here. Like literally take out loans, sell everything, put it in here, and you'll make a lot of returns if it ever goes back down there. Because if it goes back down there, you're literally getting the best discount you'll ever see in your lifetime on an index. Okay, so that's it. All right, guys. So thanks for watching, and take care, and I'll see you guys next time.